Is up, my investor friends? I am excited to talk to you guys about this today. I want to get right into it. I get this question a lot. I've been doing a lot of calls with investors and people who want to invest here in Wisconsin in properties. And one of the biggest questions or hesitations people have, and this has been consistent since I've been in real estate. I got started in 2016, and it has been the exact same conversation I've been having for the last 7 years or 8 years or whatever it's been is should I wait to buy real estate or should I just buy real estate and then hang on to it? And then the other question kind of underneath that is the market going to crash or when is it going to crash? Everybody's pretty confident they're the next, whoever the people are that guess the future and they think they can predict when the market's going to crash. And I'll tell you, none of us know when it's going to crash. But what we can do is look at the data, right? And we can look at the data and we can say, okay, based on the data, how likely is it that there's going to be a market crash? And so I want to go through some of that. And then I also want to look at answering the question, should I wait to buy real estate or should I buy real estate and wait? And so with that, we're going to go through these little bit of slides. Now, these slides I got, I'm in a real estate mastermind. And back in December, we had a guy named Barry Habib come in and he brought some knowledge bombs. And the guy was great. He's a mortgage expert. He was in the mortgage industry for over 20 years. Now he consults companies and brings a ton of data. So I'll share some of the data that he brought to this meeting, and all these slides are from him. So I did not make these slides. Okay, I'm just regurgitating information here. So I'm not this whiz guy. Okay, all I'm doing is I'm going to give you my interpretation of this and answer this question that I get pretty consistently from people by looking at the data, because I think this is pretty compelling. So when we look back, a lot of people, especially some of the people I've talked to who've been in real estate for a while, they're like, oh, let's be conservative. The market's going to crash. You don't want to get caught with your pants down, yada, 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 yada. While I agree that that is a prudent strategy, right, and that's a very safe strategy, some of those people are in a different position than somebody who's looking to get out of the day-to-day job that they're in, the W-2 job, or they're looking at saying, hey, I want to build a retirement plan for myself. I don't want to wait and bank on my company to be the one to retire me, right? I want to retire when I'm 40, not 62, where I can get an RV, drive around the country for a couple of years and die, right? Now, I'm not saying the people who were through the crash and are more conservative are that way. They just may be in a different position where maybe they bought the real estate and they waited and now they've got a ton of equity and they don't need to be as aggressive as somebody who maybe is starting out and looking to grow their portfolio. So this to me is a really interesting slide. Okay. So this is the average loan to value of homes. So if you look at 2008 when the crash happened, the average loan to value of homes was 81%. So that means basically people didn't have very much equity in their home. So when the market dipped and they had to try to get out of it, that's where you had a lot of short sales happening and that sort of thing. You can see as 2011, 13, 16, 2023, that has continued to drop. And so now we're at 42% loan to value of home. So if the market tanked, the majority of people who own a home would be just fine. They're not going to have a problem with equity. They could sell it and they could still get out and have a little bit of profit, even if they had to take a 50% haircut on the value of that property. Does that make sense? Hopefully that makes sense for you as you're watching this. Here's another interesting stat. Another thing I hear a lot of times is, oh, the market's still going to crash. Prices are inflated. They're crazy. And again, I've been hearing this since 2016 and they've only continued to go up. Interest rates go up, prices are still going up. That should have been, I think, when the Fed raised rates, they thought, oh, cool, that'll slow down housing. It hasn't, because the supply, if you look at the existing home inventory, this is 2007. We were at 4 million units available in inventory. In 2023, we're at 1.15. I mean, look at how low this is for the last 25 years. This is by far at the lowest level besides 2022. Okay. So inventories are super low. I read a stat the other day at the time I'm recording this. We're about 35% below where we need to be for new home builds. And it doesn't appear like it's going to be manageable to catch back up. We had a lot of stuff during COVID too that also hurt with supply chain. And so that put us even further back on being able to catch up to where supply needs to go. So economics 101, supply and demand. Supply is super low. That's why the prices have continued to go up, even with interest rates being high or higher than what we were used to for a few years. It's because there's a supply and demand problem, not a crash potentially going to happen here, in my opinion. Now, I'm not Robert Kiyosaki here. I can't predict if and when it's going to happen. I'm going off the data Barry provided and some of the other things that I've been reading and studying up on the market. Here's another interesting stat that I thought was interesting: the U.S. population versus inventory. So the existing home inventory, you'll see, is right there in that pink line in the middle. Now look at how low we are right now, or this was as of 2023. Okay, and then look at what's happened in the population. So in 2007, you had a big difference between inventory and population. Again, demand very low, supply very high. Here, it's the inverse of that. We're actually seeing the population has gone up 35 million people. Inventory has dropped by 3 million people. So it's pretty drastic gap that we have going on here between the population and the inventory. It's pretty interesting things. Okay. Now, realtors, you're going to love this piece because you can share this video with buyers if you want. But here's what I hear a lot of times from investor buyers and from retail buyers, obviously, but I deal more with investor buyers. But investor buyers are buying to flip to a retail buyer in a lot of cases. So this is relevant for any investor out there as well. But take a look at this. This is an example that Barry put up, the cost of waiting. So here's an example of an $800,000 house in New Jersey. Now, take that for what it's worth, your market. If you're watching this here in Wisconsin, if you're in a normal market, that's really, really high house. If you're in another market that may be really low, just look at the numbers here and break it down. So what he's using here is an example of, you got an $800,000 property. Let's say you're at 7.25% on that rate. You bought it today at 800,000. And the point he's making is if rates go down, what happens? Prices go up even higher, right? So if you're a buyer right now or a flipper looking to sell to investors, this is something you should be getting across to your buyers, is there's a cost of waiting, because if you wait, those prices are just going to go up. The old adage, marry the house, date the rate. That's basically what you're seeing here. So financially, it makes a lot of sense to marry the house and date the rate. And now you'll see here in the other example, if you wait a year, just 1 year, the property value goes up on the average in this market, 4.69% is what they're predicting that to go up in a year. So now you're looking at a property value of $837,000 versus $800,000. Okay. Your down payment's going to be a little bit different, but look at the difference already. You got a $37,000 difference there. Now we go to this next slide. Here's the payment difference. Okay. Cost to refi, that sort of thing. Property appreciation goes up 37%. Amortization, you would have got a $6,000 amortization on this loan schedule. And your cost of waiting was $43,000. So your total benefit right here, this would be cost to refi. So if you what he's saying is if you refied it in 12 months, you would have he's factoring in $4,000 of closing costs to refi it. So he's saying you take that off of this $43,000, you had the appreciation and the amortization. Your benefit to buying today was a $36,000 benefit if you bought today versus waiting for rates to go down. Again, rates go down, prices go up. Pretty standard stuff, okay? Here's another interesting fact I get. I love this slide. This is one that when I was watching this presentation, man, did this one really rock me, because I got into it after the 2012 crash, or 2007 to 2011, you'll see here. And during that time period, I've networked, talked to a lot of investors. I got started right in here in 2016, and the market had been going back up, right? And a lot of the investors that I was talking to, they were starting around here, right, or before, and so they got really jaded by going through this, and understandably, a lot of them lost everything. A lot of people went through some really, really difficult times, right? And so they're going to be more cautious in their approach. And so if you're getting advice from mentors, I think this is important. Understand where they're coming from, right? What's their previous experience? And then take that for what it's worth. It doesn't mean it's bad, it's good. People who tell me, hey man, be careful, you're going to get burned. They could very well be right? And they may be laughing at me if the market crashes in a couple of years and I'm sitting there with my pants down taking it, right? But in my experience so far, in this chart is really affirming some of that information. The housing market in general is one of the best investments somebody can make over time. Okay. And now the other important part about this is compounding interest. So what happens is when you see all the green there, you're getting, like, say in 2012, you're going to get a 6% increase, right? Well, now let's say your property was worth $100,000. Now it's worth $106,000. The next year it goes up 11%. Well, it's not going up 11% on $100,000. It's now going up 11% on $106,000, and so on and so forth. So the compounding effect of this is really, really insane. If I look at 2016 when I started buying, and 2017 when I bought really heavy, a lot of these properties now that I've held, they weren't great deals at the time. I mean, they were base hits, right? I mean, they were solid investments, had equity, all that stuff, but I wasn't retiring off of cash flow or anything like that. Now I look at what the properties are worth compared to what my basis cost is on those things. It's the old adage. I wish I would have bought more. I wish I would have bought more. And everybody says that every single year. You could talk to somebody who's like, man, last year the prices were so much more affordable. I should have bought that. I should have bought that. And that's gonna continue to happen until a black swan comes in, a major event, a war, something crazy. COVID, we thought was gonna do it. Instead, COVID, look at this. It went up 10%, 19%, and 6%. So it actually went the opposite way of what everybody predicted it would do. And look back over this. Prices in history, just because they're going up that much doesn't mean there's a crash ahead, is what Barry's saying. And look at that. 4 years, prices compounded 118%. In this date range, they compounded 93%. And if you look over the span, look at how many of these years you were at zero or negative. 1, 2, 3, right there, right? I might have missed one here too. 4, 5, 6, 7, 8, 9, 10. So out of all over this last, since 1941, you've had 10 years out of that were either 0% growth or negative growth. And of the 10, what is it? Six of the 10 were negative growth. The rest of them were all positive growth. So this to me was one of the things that said, man, historically speaking, the housing market is a really safe bet. You got really unlucky in history right here if you were involved in real estate at that time, but you had some holdings or you were trying to sell some properties. Not awesome. But even look at that, it still wasn't as terrible as I think everybody thinks. 5% loss, 12% loss, 4%, 4%, 4%. Again, that's compounding. So by here, you were really not feeling great about yourself. But if you held through this period and you made it out to 2017, 2016, you're right back to where you were and you're doing just fine. So I love this chart. This is one of my favorites. And then here, this was just something he wrapped up that I think is just looking ahead in 2022. They forecasted 5.5% appreciation. It came in at 6. 2023, they were at 6.8. It actually paced. So he was doing this in December. So they were pacing for 7 in 2023. And then in 2024, they were predicting 4.5%. I think that's probably pretty accurate based on some of the stuff I've been reading. We may be pacing even above that, 5 or 6% this year, which again is defying all odds. So imagine when rates go down, more people are going to be able to move. So inventory may go up a little bit, but you're also going to see demand continue to go up. You're going to see way more buyers flooding the market, which is going to drive prices back up. So if you're interested in buying real estate, answer to my question is buy real estate and wait. Obviously, you get this market appreciation every single year. It compounds. And there's a term I like to use, a coin called the wealth cone. And so when you start out with an investment, especially if you're higher leveraged, you're down here. The equity to what you owe is really close, right? And then over time, that gap just begins to spread and spread and spread and spread and spread. And pretty soon your property's worth all of that compounded appreciation, and tenants have paid your debt way down to here. So now you have this huge net worth gain. And again, it allows you a lot of options and allows you to live financially free. When you make that decision, you can refinance some properties and pull equity out. You can sell properties and cash in. You can do all kinds of different things, but you have to buy the assets first and then let time do its thing. So that's it. I hope this was helpful. Give me some feedback on this and let me know your thoughts. And I'm happy to help anybody. If you want to hop on a call at some point, just reach out to me and we'll love to chat with you.